Welcome, welcome. This is the second in our series of Global Ag Investing webinars. We're very happy and lucky to have our friends from CoBank here to share their wisdom on the current crisis of COVID-19 and how it's affecting the economy and agriculture as a whole. And they're going to dive deep into certain subsectors of the agricultural industry for you. I know that a lot of you are going to have questions, and we look forward to addressing all of them, and I'll try to get to as many as I can. But please, if you don't mind, keep them until the presentation is coming near its close so that you can see if your question gets answered during the course of the discussion. And then in about 40 to 45 minutes, once the presentation has completed, then we'll dive into those questions, and I will, as I said, try to do my best to address them. For any of you who don't know me yet, I'm Kate Westfall. I'm the COO of Global Ag Investing, and we're thrilled to have you all with us. We are going to go ahead and kick off our discussion, and I'm going to share my screen so that we are all on the same page. And we're going to start with Dan Kowalski. Dan is the Vice President of the Knowledge Exchange Division at CoBank. And I will let you take it away, Dan. Thanks so much for being here.
Thanks, Kate, and thanks everybody for dialing in. I hope everyone is doing well. I hope your families are doing well in these very strange times. We are making our way through the data and trying to figure out what comes next, just like everyone else is. And we thought we would just get together with you all and share some of our ideas today. So I'd like to start a little bit on kind of data that we've just gotten this week. See if I can control the slides here. There we go. Press through that. Okay. So we're getting a lot of data that is backward looking, as it always is, but it's a little bit, if it's not weekly data, to us it's really limited in its benefit right now, because we kind of know where we've been. We have a really good sense of that it was bad, it's not as bad, and hopefully it gets better from here. The challenge, let me go back one slide there. There we go. The challenge that we have here is there's a few variables that we really should be paying attention to that I think are the most important. We'll cover one here and then cover one in a few more slides. This is the initial jobless claims that we just got out this morning from last week, and it came in at 3.8 million. You can see we're now in I believe the 6th week of data that we've gotten. We're now over 30 million people that are unemployed. About 20% of the workforce is out of work. The unemployment rate that we get next Friday in another data download from the Fed will be probably in that 15% range. The discrepancy between 15 and 20 is really just gets down to details of a few, really to be counted as unemployed officially, you have to be looking for a job, and otherwise you are not counted in the actual rate. So that will be the difference between, it will not be 20% next week. It will be something less than that. But I think it's important to think back to 08-09 and how severe that downturn was. And it was very different, obviously, in the structure and the timing and the progression of the crisis. We are still, again, we're at the 6th week of the shutdown. We are now in the 7th week. We have 6 weeks of data. And at 3.8 million, we are still a pretty big multiple above where we were at the worst week in the great financial crisis, which was 700,000. So just to keep it in perspective, we are still well above one of the worst periods in modern history. And so this will carry on into May, into June. These numbers will continue to go down, but we're starting to see jobs falling off from the traditional first effects where we saw in food service, entertainment, tourism, travel, those types of things. And we're now starting to see that leach out into really all industries to some degree. And so it's getting, these numbers will go down, but I would say it's going to reach into some other industries that typically at the beginning of this would not have expected to be part of the crisis and potentially losing their jobs. All right, so real GDP, this is the number we got, I believe, yesterday. So we now know that the first quarter of the year, the economy dropped about 5%. You know, that on its head is not really that interesting, other than the fact that when you do break it down and you think about the fact that the full quarter was about 12 weeks, only about 2 weeks were really bad. The rest of it was pretty decent, and yet we still fell 5%. And that gives you a sense of what the second quarter could look like and why. Somewhere between -30 and -40% on an annualized basis is what we're looking at for Q2. We go back to the 1940s on this chart. Really nothing to even compare it to. So this is going to be we're going to be in a completely new world that is just totally different than any period of time that we've seen. So on an actual annualized basis, what we are, if you look at, I like this comparison to the Great Financial Crisis. It's recent enough and severe enough that it really is the only thing that makes sense for us to compare it to. If you go back to World War II or the Great Depression, I don't think it makes sense. We don't have as good enough data. But if you look over at the U.S. First, you can see a general projection. Now these numbers are, I will say, they're all over the place depending on who you talk to, who you subscribe to. But generally, we're kind of in this -6 to -8% range for the year for 2020. If you look, look comparably back to 2009 and what that was, we were actually only down 2.5%. And if you look at the globe for 2009, we were down 1%, and then in 2009 and 2020, the projection is to be down -3.5%. So anyway you slice it, domestically, globally, it does look like we're going to have somewhere in the range of twice as bad or 3 times as bad a recession if you just look at these kind of, very basic numbers, that things are going to get much more severe than what they already are. All right. Okay. So what that means for GDP going forward, this is kind of a consensus shape of what a lot of economists are saying. It's a kind of a mix between, I hate to say it, it's a mix between a U and a swoosh, whatever you want to call it. The red line is kind of the consensus that we will be back to the 2019 fourth quarter levels of GDP sometime by mid next year. So around second quarter, maybe late second quarter. That's kind of where we are now. Obviously, there's a lot of factors that are baked into that are highly variable. We don't know yet how quickly we'll come out of this. We don't know how fast people will go back out into public and how fast the economy will start to ramp back up after the shutdown. We're kind of at the beginning stages of that. The blue line gives you a sense of what the economy might really, the struggles that the economy might undertake if we do have a fall or winter peak of cases, which is highly likely. We had it in the Spanish flu in 1918. We had a second peak. We actually had 3 peaks in both the Spanish flu and SARS in 2003. And so if we do have to shut down again at some point in the next year, it could get pretty ugly. There's probably going to be a lot more businesses that go out that can't sustain through another shutdown. The spending will probably be largely exhausted, and there's a good chance that we're going to have some permanent damage to the economy. It will be hard to bring it back up to that pre-virus level. So that's the risk, and what makes it so important that we get this right the first time, that we don't move forward too quickly, and that when we do move forward, whatever that timing is, when it's appropriate for the federal government or the states, that they get it right, that they track the numbers, and that we all kind of do what we're told, I guess, to some degree. So if you look at individual states where cases are decreasing, we do see some good momentum in some of these states, some more than others. Louisiana is really a great case of a fast spike and a fast subsiding of cases. But some of the other ones have spiked and have kind of come down a little bit, but they're still relatively high. If you look to the right, where cases are mostly the same, you have a lot of states that peaked, came down a little bit, and have kind of plateaued. Still pretty high, still a lot of cases being added every day. And so this is the challenge that I don't envy the governors having to try and figure this out. When is the appropriate time to open? there is increasing, the cries are getting louder to open up the economies for very good reason, that people are experiencing an awful lot of financial pain, and they want the opportunity to get back to work and not go deeper into their savings or deeper into debt. It is just a very hard thing to weigh the short-term versus the long-term risk if we do come back and have another problem. Okay, so that's the first element, opening up. Here's the risk, the health risk. What about consumers feeling comfortable about actually going out? This is a chart that shows how did people feel about 3 weeks ago about going out, eating at restaurants, shopping, doing different things out in the public space. And then just last week. So this is they've done the same poll separated by 2 weeks, and the latest was last week. So we're not seeing a lot of difference even as we get closer to these and actually start some of these state openings across the country. A lot of people, if you look at those dark green sections of the bars, those are pretty small of people feeling comfortable. You're talking about maybe 15% of the population, maybe 20 in some cases, maybe up to 25. But then there's an awful lot of people in those lighter green shades. And then there's a fair amount of people in the gray shades as well that just want more information. They're not quite sure yet. But, what I like to say is that, if you take this into account, recognize that there is still maybe 20, 25% of the population that's going to be comfortable in the next couple months. I mean, we're not even talking about weeks. We're talking about the next couple months that are going to be comfortable to get out into society. I think that becomes part of the problem. That you can open up businesses, open up economies, but those people may not want to be there. About 40% of total consumer spending is made by folks that are over the age of 55. That's a pretty staggering number. And if you think about people that like to eat out, people that like to shop, I mean, they're as much in that category as anybody else, and they have the dollars more so than the younger folks in the economy. So it's going to be interesting to see what kind of economy we have over the next couple months as people start to trickle back into these establishments. Okay, on to the next slide. Great. Okay, so the flip side of that issue is maybe the consumers will come out, maybe they won't. What about the workers? So half of U.S. workers now stand to earn more from their unemployment than they earned at their job before COVID hit. So the federal government boosted state-level unemployment by $600 a week. So now you can see by that chart that was put together by the Wall Street Journal, did a good job putting together this data and telling the story. Basically, the idea here is that half of workers are now disincentivized to go back to work if they are laid off, at least through July, right? So they're weighing, okay, maybe they make a little bit more if they go back to work, maybe they make less. But regardless of what it is, there's a risk factor in there for their health and their safety. Do they want to go back to that job? Maybe they really don't like that job. A lot of the jobs that we talked about initially that came out were food service, some of the jobs that just are relatively low income and are not super exciting gigs that folks had. So they may just try and wait it out over the next month, 2 months, 3 months. They have till the end of July. So that's part of the problem, that unemployment has now basically brought the weekly level of income up to an annualized level of about $47,000, $48,000 per year. And that is more than a lot of the lower income workers make. We've been hearing a lot of this over the last several weeks from our customers, concerned about our smaller customers that maybe have taken PPP and bringing their workers back on, all sorts of situations. But bottom line is that they are concerned about disincentives that may keep their workers at home. And so that's a challenge. We know some of the states are fighting against this, red states in particular, Oklahoma, Iowa, some others that are saying they're going to crack down on this. I think it's going to be a very hard thing to do. You have a lot of things at play here. You have different ages, risk categories. just a lot of things. How do you force someone to go back when they don't feel safe? So those are some of the challenges. Hopefully that paints a picture for the road ahead, and didn't want to go into too much detail, but that's kind of what we're looking at from a macro perspective as we try to feel out the rest of agriculture. What is, you know, from the grain side, the protein side, the dairy side, and some of the other sectors we won't cover today, this is at least the backdrop that we're going to do it against. So with that, let me stop and pass the baton to Ken to cover the grain sector.
Terrific. Thank you, Dan. I'm just going to make sure that I have control of the screen. It's interesting how without that dynamic, everything that I'm about to say would probably not be as exciting. Terrific. So good afternoon, everyone. Thanks so much for joining us. My focus is on the grain, ethanol, and farm supply sectors, and arguably while these are all vastly different, they are interconnected. So as we think about the goal here, what is the impact of COVID-19 and the related economic shutdown on these sectors? Just advancing the slide. Here the answer is threefold. Ethanol has been under tremendous pressure. It's a monumental demand destruction because of shelter in place, obviously reduced gasoline usage as we are sheltering in place, not going too many places. I think what's interesting is I have the same tank of gas in my car that I had 7 weeks ago. Others are in that same position. So when you think about how much demand has gone away, it's significant. The good news is production has been cut to align with current realities. However, any way you look at it, we have a lower demand for corn. On the grain sector, including corn, but also broadening that to soybeans and wheat, it's a mixed bag, but export trends are actually encouraging. Hence our short-term outlook is neutral to negative. Corn prices and basis have come under significant pressure because of the ethanol situation, along with reduced feed and lower corn exports. However, soybean and wheat have generally held up better. The prices have moved up and then come back down, but held and defended better than corn. One of the interesting issues on the wheat space is planting and new production is at, I believe, a 110-year low. There's been good price support to where foreign buyers have come in to purchase the product. So we've actually seen a pretty encouraging export picture there. On the farm supply sector, and farm supply at CoBank is thought of as the farm input sector. That sector I used to cover at Rabobank. However, farm supply here is geared towards cooperatives that provide agronomic service as well as inputs. Look, based on every channel check we've had so far, COVID has had minimal impact. Recent indications on crop progress have been very strong this month. Iowa and Illinois, corn and soybean are doing quite well, up to 40% already planted. Weather has been favorable. That was, as you all know, a terrible situation last year. A shortened planting season, a delayed planting season, then a shortened harvest. Weather figured prominently there. Thus far, things have been going decent. Agronomic inventories at the cooperatives and ag retail are adequate to meet demand. The real issue is supply chain focus, depending on how long the economy stays sort of mostly shut. And what I mean there is external sourcing ingredients and chemicals and food from non-U.S. Parties. The supply chains in the U.S. are generally functioning pretty well. I would also just make mention that obviously the health of the U.S. farmer, which is not in great shape, is the caveat to our short-term outlook of stable. So as most of you know my style, I usually like to give you the conclusions up front and then work backwards in terms of the rationale and supporting analysis. So let me do that by offering 5 observations. Observation number 1, a recession was inevitable. The forced global shutdown due to COVID was a black swan that has made what should have been a, if you will, a garden variety recession into something much different. Here, this chart articulates a very simple matrix that I used to use when I was focused on Wall Street and investing. Please forgive, I jumped ahead there. Here, as inflation goes down and GDP falls, the ensuing situation is a recession. In 2019, we had, what, a decade, if not slightly more, of an economic recovery. We actually had GDP moving lower despite estimates of continued growth. That suggested to us that we were at the mature stage. It wasn't exactly a brilliant call, but it was what it was. And of course, we had 2 warnings, if not more, last year with the yield curve inversions to suggest that things might be slowing down. Nonetheless, a recession was expected, but now we're in a different picture, which Dan articulated quite well. Second observation is that U.S. farmer financial health was already under pressure going into 2020, and looking forward, additional pain is inevitable. Let me tell you what you're looking at and give you a little context. To the left of the chart, you see, well, first of all, this chart is a ratio of farm debt to farm income, and this is all lines of business, meaning crop, livestock, dairy together. As you see on the left-hand side, heading into the 1980s farm crisis, there were 4 years where this ratio was above 4, and then it spiked to 10, came back down, and then obviously spiked higher as the farm economy was under pressure. Looking at the last few years, we've had that elevated level since 2015, and I think everyone knows we're in the, call it the 6th, 7th, or 8th year, depending on when you measure it, of a negative cycle for crop farming. So as we look to 2020, we've already had stress. We actually had 5 years this time, not 4 years. And 2020 is going to be another very, very difficult year. 2 things are different at now versus the 80s. Interest rates are obviously low / near zero. So the cost of servicing that debt is better. Beyond that, we have continued government support, and the 16 to 19 billion that we've heard about. My expectation is that that goes up considerably. Last year, if memory serves, was about 24-ish billion. I think we're probably going to see that higher. So additional pain is inevitable, and the issue is, what do you do in this situation if you're a grower or a company involved in the food and ag value chain? Moving on to the third observation. Grain exports are mixed when you start with corn, but then when you look at both soybean and wheat together with corn, it's actually kind of encouraging. So let's just define again what we're looking at. This is accumulated exports by marketing year for corn, soybean, and wheat. Corn is under tremendous pressure. Since September, export volumes are down 35%. The picture is a bit different in soybean and wheat. And what I will point to here is that despite views to the contrary, or expected views about what China would or wouldn't do, they're actually buying soybeans. That's a good thing. Mexico buying less, Japan buying less, but all in, soybean volume is up 5%. And by the way, we shouldn't lose sight on a metric ton basis that soybeans are basically almost as large as corn metric ton exports. Wheat has had an interesting run. Wheat is up 7%. Mexico has been a big buyer there. We see some factors in the Black Sea region, which portend for additional wheat exports through the year. We had a few situations going on here. We had pretty tight stocks of wheat. We had high quality, and we had low prices, all of which accrued to the benefit of wheat export and demand. So the picture here is pretty good, and I must tell you, better than I had initially expected. However, and this is the fourth observation, the flight to the US dollar amidst market turmoil has obviously strengthened the dollar, and relative to Brazil and Russia, the weak currencies on their side makes our exports more expensive and therefore less competitive. So as excited as I am about the parsing the data on the exports, the real is at a historical low. Yes, China bought more beans from us than Brazil last month. There were some other factors there. I think they'll still continue to buy, but you can't ignore how how foreign exchange rates play into here. The fifth observation is that crop progress continues. The weather outlook remains favorable. And as I turn here comes the sun. What's interesting about crop farming is the dynamics of the business are sort of your sheltering place at your farm or with a limited group of people to begin with. The channel checks we've done with Midwest and Great Plains growers are that after a long winter before COVID, they were chomping at the bit to get out and plant, and that's exactly what they're doing. Moving to sector strategic positioning, and this is my last slide. What I've attempted to do here is break down, whoops, Kate, I must tell you, my mouse must be really robust, so thank you for helping. Breaking down the long-term outlooks, let me start with a little philosophy and then get into the individual sectors. One of the, steadfast rules is you should never let a good crisis go to waste. Economic chaos always presents opportunities, but importantly, it calls attention to things that we all know needed to change, but lack the catalyst. We now have that catalyst, so let's think about industry transformation and what opportunities lie ahead. In the ethanol space, excess supply needs to be rationalized, hard stop. The exit of weaker players, however, will be positive for top tier producers, and the growth opportunity exporting fuel ethanol to China still exists. Order of magnitude, what the growth rate of demand for China, at least measured through the end of 19. Gas consumption was mid to high single digits for the last 10 years. U.S. ethanol, fuel ethanol production was, call it about 3.5%, 3.5% compound annual growth, and growth in U.S. drivers as well as GDP were all below that. So the opportunity for growth in China is still there. On the grain side, as most everyone in the phone call knows, since the 1970s and mid-70s, the U.S. share of grain exports has come down dramatically. Exports are actually showing momentum now. Soy and wheat, quite a bit. Corn, the recent momentum is relative to the March reading. The resolution of trade agreements actually is starting to pay dividends and show up in the numbers. And in my humble opinion, we have a golden opportunity to reduce production costs, regain that export edge that we once had. And what's the answer to doing this? Something that we've talked about quite a bit, and GAI has talked about for the past 5-6 years that I've worked with them, and that's the digital transformation of agriculture. In the farm supply sector, again, my comments here are both related to cooperatives as well as ag retailers. What we're focusing on longer term is sourcing inputs from non-US locations. Right now, the supply chains are working. The global supply chain in terms of Moroccan phosphate and chemicals from China, that is unclear if we stay sort of locked in an economic downturn and you know, ports and countries stay closed after sort of July, August. So we're watching that. But the opportunity here is that the cooperative model has long needed to change and evolve. And we believe that the opportunity exists from moving away from pure commission-based sales, giving away the agronomic advice for free and selling inputs for a commission. The opportunity is to move away from that and move into offering agronomic advice for sort of advice for a service, whether it be field diagnostics, prescriptive, or other advice. So that's an opportunity long term. It intersects with the digitalization of agriculture, but it's a little bit different. Think about how it used to be where you would go to the stockbroker, the insurance agent, the property casualty insurer, and your banker, and each would derive a fee for the products they were selling. At some point, the concept of having a financial planner to advise you for a fee came to fruition, and that's what we're talking about here. Without any further delay, let me turn this over to William Rutherford Sawyer, who is going to provide some detailed comments about what's happening in the protein side.
Thank you, Ken. I appreciate that introduction. Thank you, everybody, for dialing in this afternoon. You know, as Dan and Ken are laying out for us, there's a high degree of volatility. There's a high degree of uncertainty when it comes to food and ag today, and the macro environment as well. Of all the sectors that, as I've heard presentations over the last few weeks from many economists across the industry, agriculture broadly, you know, we do see that animal protein is to some degree experiencing the most disruption, is experiencing the most in the way of losses. That's not a title or a crown that I wish for our customers and for the producers in the United States, but I'm afraid it might be the reality that we're facing right now. I think, you know, over the next few minutes, I'd like to spend a little time discussing the key issues and the key dynamics that we see facing animal protein today. You know, the recent developments of the last few weeks are some that have brought the animal protein sector into the spotlight, well beyond rural America, well beyond agriculture, to where President Trump just a couple of days ago was speaking on the issues within the animal protein sector. So let's explore what those are, but let's first discuss where we see the consumer when it comes to food consumption, meat consumption, whether that's at retail or restaurants, which obviously the food service side of the supply chain is anything but normal, significantly below year-ago levels. That's still the case. Second, you know, we see COVID-19 cases in and around animal protein processing plants, especially in the beef and pork sector. It's driven a dozen, probably 15 or 20 plant closures over the last month. Yes, not over the last year or 6 months, just in the last 30 days. So it's been a significant change. Third, capacity utilization due to those plant closures and plant slowdowns. Both of those are key issues here. We see capacity utilization for animal protein at levels we never thought was really possible. And that's driving a lot of stress for packers and for producers. Fourth, the profitability margins as a result are levels that, again, we haven't seen in many, many years. You know, we all kind of think in the industry about, well, how were things during the Great Recession? That might be a good place to compare. We're well through that at this point. And finally, the topic of the day, or at least of the last 48 hours, President Trump's executive order keeping meat and poultry plants open. What are the implications? That's where we will round things out. First, let's talk about the consumer. Where are they buying their food? More importantly today, where are they not buying their food? As we and at CoBank and everyone on the call, I'm sure, realizes restaurants are anything but normal. Over the course of March, we saw the industry in food service go from modest growth, as it has for many years since the Great Recession, fall to double-digit declines versus prior year levels. And you can see by late March, the industry was 65, 70% below prior year levels. During that time, the consumer went to where things were open and went to where they felt a little bit more safe, and grocery retail was not just the best game in town, the only game in town. And so consumers really stockpiled food in the month of March. Food consumption, of all the variables we think about in agriculture, is a little bit simple when it's effectively 50-50 between at home and away from home. And when you look at late March, you'll notice that food service was down about 2/3, retail or grocery was up about 2/3. So that started to make some sense. Well, where we look at the industry today is that food service remains significantly below 40 to 50%, even 60% just a couple weeks ago, while the retail market is seeing just modest growth. So that does indicate to us that food expenditures are down overall versus where we were prior to the outbreak of COVID-19 just a couple months ago. But within my sector, within animal protein, we are doing our best to catch up with the supply chain, catch up with the lack of food service especially. And so we as an animal protein are seeing levels of growth beyond the overall grocery store. At the third week of March, we were approaching 100% growth of the meat department within retail versus prior year levels. So when we think about the month of March, at least for animal protein, we think about the animal protein consumer at retail buying about a month and a half worth of food during the month, but that rate is slowing. As you can see, during the last few weeks of April, that rate's gone from 80 to 90% down to 30 or 40, which is still pretty good. Don't get me wrong. But the week of April 19th, which does include Easter, does show a change in the trend. Will that change in the trend continue when we look at the last week of data, which will come out in a few days, or will it show a rebound? It's hard to know how much Easter is noise in this data. I hope it is, to be honest, because otherwise we're looking at the beginning signs of a lack of animal protein supply in the grocery store. We know that the grocery store has a lot of supply available to it, given that restaurants aren't calling for more orders. But if the plants across beef and pork continue to slow, as we know that they are, that's going to start to impact retail grocery supplies. I just hope that we're not seeing it already now that this data only goes through mid-April. But when we look at the plants, we look at a lot of coronavirus cases on a per capita basis. A month ago, beef and pork plants had very few cases in and around their plants versus the U.S. average of coronavirus. You can see April 1st, cases in red meat plants were a fraction, maybe 15 to 20% of the U.S. average. Fast forward just 30 days, as of yesterday, there are more COVID cases on a per capita basis around beef plants than the U.S. average, and pork plants are not too far behind. And so that drives a map like you see on the other side of the slide here, where you see a lot of plants either closed or with limited operations. Unfortunately, there's a lot of closures and not as many limited operations. That, I think, will start to change. When I talk about the President Trump's executive order, we'll start to see how that plays out. But one concern we need to think about is that if you look at the trajectory of COVID cases nationally, that's obviously slowing. COVID cases in and around meat plants are not yet showing signs of a plateau. That's going to be an issue when we think about labor, not just the plants themselves. But these plants are operating at a level we've never seen before. The title says it all here. We've lost about 40% of our beef and pork operating capacity in just the last month. When we ended the first quarter, the end of March, obviously, we were operating at around 100% capacity utilization. When I fast forward and I look at the data so far this week, which includes beef and pork slaughter Monday, Tuesday, and Wednesday of this week, we're operating below 60% capacity utilization. We're seeing a backup of hogs, not so much on the beef and cattle side of things, but the hog backup is approaching 1 million hogs per week. That's where that's what's implied in the data for this week, 915,000 hogs, and there's not a lot of opportunities to send those pigs other places. Our housing supply, it largely is what it is, and so culling of herds, euthanasia, all of that horrible part of this process is impacting the supply chain, and we're seeing that in numbers we'd really wish we weren't, but that's unfortunately the byproduct of plant closures and plant slowdowns. What's key as we follow the news and track this data day to day is that the capacity where we are today, call it around 60%, about half of that can be explained through plant closures. The other half is through plant slowdowns. And those slowdowns are key as plants reopen, which we think they will over the next couple of weeks. But in the end, will labor come back and to what degree? Let's talk about that in a couple of slides. But this is where we are today. And this is where we are when it comes to profitability for producers as a result. First quarter of 2020 wasn't great. It wasn't, a fantastic year or fantastic quarter for profitability of producers, especially on the pork side of things. It's unfortunate to see for the pork sector with exports climbing to all-time highs, driven by trade to China. The producers on average, as you can see here, on a cash basis, were in the red. Beef wasn't too far into the black, and neither was chicken. One thing they now have in common is all these margins over the course of April are very much into the red, beef and pork especially, realizing losses well outside of the Tyson plant fire on beef last August or the Great Recession for any of these sectors. So the stress in the sectors, whether it's beef, pork, or chicken, is most pronounced today at the producer level, driving rationalization of supply, whether that's eggs, whether that's feeder pigs, and you move on from there. So they're seeing a significant amount of pressure. And where are we going to go from here? More influence today in animal protein coming from DC than we've probably seen in a number of years. The USDA, as we have here with Secretary Perdue in the middle, released a $19 billion aid package for agriculture a couple of weeks ago. Unfortunately, very little of that money will go to help alleviate the losses of livestock producers due to the caps of $125,000 per commodity per entity. Many of the producers that we all know are well outside of that range and well too large for that to make too much of a difference. But Wednesday and Tuesday this week were step changes, I think, in the right direction. Where do we think this falls out? Where in general, we know that there's still details to come, but as we summarize these details of what we do know, we think this is going to help with a number of our plant issues, but really not do a lot to affect our people issues. And so on the plant side, we do see this executive order helping plants that looked like they were going to close this week or next week to remain open. That's a good thing. The second thing is that some of the plants that were cautious about reopening due to legal pressure and political pressure most likely will be reopening in the near future as a result. These are all positive things. This gives us the view that most likely, with our fingers crossed, that this week will be the bottom when it comes to the trend in capacity utilization, and we move up from here. That's a very positive sign, but how quickly can we rebound? That's where labor becomes the constraint. As Dan discussed, with unemployment benefits being as robust as they are today, and those benefits extending through the end of July, labor supply is going to be quite a constraint. So while we may reopen plants and give employees more incentives, there's still a significant amount of unemployment incentives that may be larger than what the plants can provide, and that's going to be an issue. But the plants are doing a lot. I'm highlighting here some pictures of investments in PPE and partitions between employees. These are all things to help reduce the spread of coronavirus, which is obviously key today. I'll leave everyone with this slide, and this highlights a few of the main bullet points, but let me give a few major takeaways. And I think the takeaways are primarily that rather than us thinking about agriculture or animal protein quarter by quarter, year after year, today we're thinking about it based on today. Where are we today versus where we were last week or a few weeks ago? The story is changing so quickly, and the political environment is changing so significantly. It's important for us to follow it to that degree. At CoBank and at Knowledge Exchange, we're doing our best, I can guarantee you, to stay on top of those issues. Second, I do think that when I speak to producers and processors across animal protein, it's unbelievable the information sharing that's going on to allow folks to manage through this uncertain environment. You know, some producers are exposed to plants that are closed, and some are exposed to plants that are operating at 85 or 90% capacity. So there's no real way to try to generalize it. And that's where working together has made such a big difference. I look forward to your questions, but I think I'll, at this point, pass it back to Kate. Thanks so much.
Thanks, Will. I'm going to pass it back to Dan, I think, for one more slide. Let's see, Dan, can you control the screen now?
We shall see. I clicked on it. Hopefully it goes. There we go.
Okay. Oh, now I messed it up.
All right. That's all right. So just really quickly, so hopefully we have time for at least a couple questions. Covering dairy, look, the challenges are immense. We know that the industry has been dumping milk for the past several weeks just because we're producing far more than what we can. There are regions across the United States, especially up in the Northeast, that, you know, in the range of half, 40 to 50% of the fluid milk that's produced that goes into in some form or fashion goes into food service. And so with that kind of an instant change, there's just massive amounts of pain. Producers are doing some things that they can to try to mitigate some of this as quickly as it's hit them. They were starting to ramp up. We saw over the last couple of months, we saw the herd increasing in size in some regions to a really large extent, in some other regions to a lesser extent. But the industry was in growth mode, unfortunately, coming into the spring flush when they have the most amount of milk of any time during the year. So it really did hit at the worst possible time. So producers are culling their herd. Over the last couple of weeks, they were culling their herd at the highest rate for this time of year in 30 years. So it's been painful, but they've been doing what they can. The dumping of milk, you can see the headline there that the industry is producing 10 to 15% more than what's being consumed. And we're seeing multi-decade lows in prices of butter and cheese, and powder is also been strained. So the export markets have been very weak, and plenty of powder on the market from other parts of the world, from Oceania and other places. So the only thing that's held up really is whey prices, and that's largely a function of the fact that less cheese is now being produced. So that's a byproduct of cheese. So it's a difficult situation. I guess the only upside that you could say, the silver lining, is that with all of the painful things that are being done in the sector to try and minimize the amount of waste and minimize the amount of milk coming into the system, we are seeing the out futures months for Class 3 and Class 4 showing some recovery, more so on Class 3 than Class 4. And it's not a great price that any farmer would be excited about, but rather than 10 and change or $11, we do get out to, at least right now, looks out to $14.50, $15 by October. And so that's at least something that's a turn to the positive, that at least we may have a healthier environment come Q3 and certainly more hope for Q4. So why don't I stop there, turn it back to you, Kate, and then hopefully we have some time for questions.
That's great. Thanks so much, Dan. I'm going to ask Ken and Will to come back so we can see them. Hi, guys. Okay, we have quite a lot of questions that have come in. Will, it seems like multiple people are concerned about workers in the meat plants being willing to return. Do you have any data on what that looks like? There's been some discussion, I guess, about whether they can make them ineligible for unemployment, or how can you force people who are afraid for their health to re-enter these situations?
Right. Yeah. I don't expect that we'll be in a situation or an environment where forcing people to come into a meat plant is going to be the reality. I think that's one thing that's important to realize, and it's hard sometimes, I think, for me to totally put my mind around what the moving parts are, is that some plants are actually seeing better attendance through this period than others. I think those plants where they've had fewer cases of coronavirus, fewer illnesses, that's definitely helping. So there are some examples where that's come to pass. How many people will come back to work? That is a big question. We don't have a lot to go on because there aren't very many plants that have reopened. There have been 2 beef plants, but they've only started back in the last 3 or 4 days. So it's hard to really get much to go by there. What I will say is that incentives for employees, whether those are union plants or non-union plants, whether those beef or pork, since that's primarily the sectors we're talking here, those incentives are higher and better than they have probably ever been. It's a question, of course, how high do they need to be to get enough folks in the plants? But we're going to find out very soon here. I think by this time next week, we'll have a much better answer because there'll be more plants that'll have reopened. So we'll have something to go by.
Okay, great. Ken, in terms of your observations, there have been a couple of questions on how the outlook for specialty crops is. I know you're focused more on commodities in this case, but is there any light you can shed on specialty crops or other areas of the grocery store?
So maybe Dan, I'll turn that to you. I know you did some work in California recently and had some insight on the specialty crops.
Yeah, sorry, Kate. Can you repeat the question?
Yeah, there were just a couple of questions on observations that might include the outlook for specialty.
Sure.
Yeah, thanks.
Yeah, so obviously we've seen, I think the biggest impact on specialty crops we saw through Florida. They just got annihilated, unfortunately. The timing seems to be really, really important with this virus of where it hits and when. And so we've seen that with dairy, and we saw that with specialty crops in Florida. They had a combination of a problem with labor, a lot of confusion about H-2A coming in with a lot of policy changes that were happening at the same time. Could they get them in? Could they not? Also some challenges of whether some of these workers wanted to come in. There's a risk of infection, of travel, of all those things. And so we saw, unfortunately, an awful lot of crops being plowed under just with a lack of market for them to go to. There are a lot of these fresh produce products have a very structured market that they go through, and a lot of them have contracts long out for many months beforehand, and they are contracted to go to a certain food service distributor who sends them on into different restaurants, and that whole supply chain just broke down, within a couple weeks, just done. And so the folks that were already contracted to go into grocery stores had plenty of supply to fill in the grocery store. And maybe there was a little bit of carryover to bring some of those other folks that lost their market, but you saw that all over the state. And so, yeah, earlier in the week, I was talking with several people in California about the coming challenges there. They have upcoming rolling harvests through the rest of the summer out into the fall. And so they've gotten to watch what happened in Florida. Major challenges there too. So you're talking about another statistic, all my statistics seem to come with this number 40, but about 40% of fresh produce, it goes into the food service sector. So you think about tomatoes, lettuce, things that are grown on a repetitive basis through California and are harvested multiple times a year, those types of things, there's nowhere for it to go. And so they're trying to figure out, we talked with chairs of the Ag Committee on Monday, trying to think about ways that we can help this situation. And that, with the amount of food that's produced, really California is our salad bowl, if you will, not our bread basket. And the amount that's produced out there feeds, the entire country really, and feeds part of the rest of the world. You're going to overwhelm your food banks in California in an instant. And so I was proposing that you could get together, talk to Washington, and get a network of being able to ship this stuff out as you normally would and just take it to food banks rather than grocery stores. There's a lot of different things being talked about, but unfortunately, the last thing I'll say before sounding too down in the dumps, there are some products and specialty crops that are actually doing okay to actually doing well. And so I looked at prices last weekend of a lot of specialty crops from different types of fruits and vegetables to tree nuts. Tree nuts have actually been faring quite well. There's a little bit of weakness, but not a lot. Walnuts came into this really weak, but almonds and pistachios are doing quite well. It's kind of all over the board when it comes to vegetables. Depends on the harvest season, depends on seasonality. But I can tell you there's some that are doing really well, actually, that you'd be surprised by, and some that are not doing well at all. And so it is a very mixed bag, if you will, in specialty crops right now.
Great, thanks. I know in New York, our governor is working with the upstate dairies and Chobani and Cabot Creamery to try to create that funnel into the food banks here in the city, but it seems like sort of a Band-Aid option. So here's a question, maybe Ken, you can address this one. In terms of the collapse of the meat value chain, what does that mean for soybean crushing and future soybean demand? And there are also some questions that sort of fall in that category about alternative proteins, but I'll let you talk about increased demand for soybean meal maybe.
So Will and I have chatted about this a little bit. I think what's interesting is distiller grains, dry distiller and wet distiller grains, which are a byproduct of ethanol, producing less ethanol, less DDGs, higher prices for DDGs, hello soybean, So there's a substitution effect there that's actually been, positive for that use, that crop or that product in terms of feed. However, the elephant in the room, or the pig, calf, and chicken. What are we? I was going to say turkey because turkey never gets the respect it should, and it's a heck of a product. But the species here, what you've articulated is that there's some puts and takes in terms of when animal protein demand rebounds. So, Kate, the way I look at it, and I'll let Will comment, is that right now, to the extent grain feed is being used for more maintenance as opposed to fattening up the animal before slaughter, then there's a step function change there. Of course, if there's less, new protein production, then obviously that changes the dynamic as well. But I think it's somewhat of a fluid situation, but the trend line seems to be down, at least in the short term.
And I would only add, Kate, to that on the protein side. One of the trends that has seen pretty reasonable investment on the animal protein sector in the last 4 or 5 years has been, the slow grow movement in animal protein, something that we never thought would be relevant in a 15, 20% unemployment environment, but slow grow in the way that we're talking about it now, which means instead of raising that pig for 6 months, we're gonna have to stretch that out to 7 or 8 months. Every supply chain in animal protein is getting stretched out right now, and and that feed conversion ratio we have in our model, we're going to have to change, and it's not going to be to the positive. It's going to take more feed to get that extra pound, just because we're having to kick the can down the road of bringing those animals to slaughter, not in April because we don't have anything open, and probably not in early to mid-May because they're only starting, hopefully, to rebound. We're having to move down in that direction. And so as a result, that's going to, while we have fewer animals, they're going to eat more. So there's going to be some offset there. And I think the movement of DDGs, from DDGs into soybean meal for the livestock sector is a month in the past for a lot of folks, which I hate to say if crush margins aren't good now, I'm sure that's not going to make it any better given the trajectory we're seeing in meat production. Sorry.
This is a rosy conversation. We'll all get through it together. Dan, maybe you can address this one. My friend Jacob is asking why the stock market is still overvalued relative to joblessness and the real economy.
Great question. I think a lot of people are asking that all over the world right now. And my simple response to that would be, don't ever fight the Fed. It's really kind of a cliche, but I think it's true. I think if you look at what the Fed's done, it's really interesting that a lot of their programs are not even active yet. They announced them weeks ago. Many of their programs have yet to get off the ground. They haven't been funded. There's no assets allocated to them. It's simply the messaging in a lot of cases from the Fed that really puts the financial markets at ease, and that's enough to get people comfortable, to get back into the markets and to buy equities. I think another big part of it is that when you look at Main Street and you look at Wall Street, they are two very, very different things. We are not buying hair salons. We are not buying local delis. We're not buying all the businesses on Wall Street that you and I care about when we walk out our door and want to go have a cup of coffee down the street. And those are two very different markets. So a lot of these larger, the companies in the S&P 500, some of them that are hit really hard, like the airlines or the auto industry, really needed some help, and they may not have made it through this without some support from the government. But many of the other ones came in really strong. Many of them came in with really fat balance sheets with a lot of cash, and they're going to be able, if they need to go get money, they have the public markets to do it. They can issue more stock. They can do what they need to do and probably pull on some really large lines. And we've seen that a lot of these companies have started pulling on their lines over the last few weeks. And so everybody is piling up cash as kind of a war chest to get through this. And so the companies you're looking at on Wall Street and what we're seeing day to day and when we walk out our door are two totally different things right now. And that is in large part because of what the Fed has done and has made people feel comfortable to get back in the markets. I don't predict direction of S&P or Dow, but given my economic forecast and where I think things are going, I don't think the volatility is over. I'll just say that.
Thank you. Here's a banking question. I'm not sure if any of you know the answer, but let's give it a shot. Is Farm Credit System underwriting loans with a COVID risk premium? What is the current range of borrowing rates for corn and bean farmers in Illinois, for example, versus table grape farmers in California?
I'll take that. We really don't all three of us are from CoBank, just to give a really quick synopsis of the Farm Credit System, how it's structured. The three of us are at CoBank. We focus primarily on cooperatives and processors. So thankfully, Will and Ken have fantastic glimpses into the folks that process the grains and process the different animal protein products. We have secondary information as we go down towards the production level of the farm. And so we unless we go and have direct conversations about what's being, what do those interest rates look like, we don't really have accessibility to that. I would say just to give a little bit of glimpse into how CoBank has been affected, and broadly the Farm Credit System, how we've been affected by COVID in our lending. We are a PPP approved lender, so we have been since the early days of PPP. It's not just CoBank, there are other institutions that are also approved lenders. So we have been pushing through those applications as fast as we can. We have gotten several of them through already through the first round. We had them piled up waiting to be sent in as soon as the gates opened for PPP2. And so we've been shuffling those through as well. And so that's been a big effort for us. Some of the other programs that are going on, we are not eligible for. There was a question on another webinar we did for a different program. I think it was the Main Street Fed program, and we are not an approved lender for that. As far as our lending directly without any of the other programs, I think business is kind of normal right now. If you're around agriculture long enough, certainly around CoBank or Farm Credit long enough, you live through these cycles. We've gone through them in 08, 09. We've gone through them in different commodities at different periods, and we make our way through this. The reason why we're in business, those of us that lend and understand this industry, is that we're able to stand with our customers in good times and bad. And that is a message from the Farm Credit Council. That's a message from any association you'll talk to out there in the system, and that's a message you'll hear from CoBank. So for us, we've been prepared for this. We don't always know when it's going to happen, but we're open for business, and our business operations really aren't much different than what they were 2 months ago.
Great. Well, I have a few more questions, but we have now gone over our time, and I feel like that's a really nice button on it to end on. So I will make sure that you guys get a list of any of the questions that we didn't get to, but I just want to say thank you so much to all of you. This was an excellent conversation. We at Global Ag Investing are so lucky to have friends like you. And I want to say thank you to Greg Warren with American Ag Credit for helping get this together. And I hope we'll see all of our listeners at our next webinar. Thanks so much. Stay safe.
Thank you, Kate. Thank you, everyone.
Take care.